Good afternoon. My name is John Poulter. I'm the portfolio manager for the pension funds. I'm here today to talk to you a little bit about what I've been doing in the pension funds with respect to the different allocations, changes that I've made through the summer, and changes I've made in preparation for the end of the year, and as we move into 2023. I'm going to start off with an overview of what I've been doing in the equity markets, and then I'm going to briefly touch on fixed income, and along the way, just discuss a few related issues. I guess anybody that has followed what I have been writing in the commentaries for the pension funds will know a couple topics that I've been looking at over the years, and these are important for the asset allocations today, because one of the main themes that I've been kind of watching with a lot of caution over the last few years was the theme of the top-heavy nature of the U.S. markets, and specifically the S&P 500. And the reason I want to bring that up today is because after the last year and the amount of damage that's happened to a lot of the new economy and the technology-related names that have been the headline grabbers for the last couple of years, I'd say, the give back in performance by these companies is notable, and it's also making me look at the U.S. market in a very different way. The types of companies I'm talking about are usually embodied in the QQQ index, which looks at the big NASDAQ names. But I can throw out a couple of the kind of the household names that we all know about, like Facebook, or now Meta, which is down by over 2/3 from 379 down to 109. Amazon, of course, which is down by half, 176 down to 92 and change. There's a company called Match Group, which is another darling not too long ago, that's also down by 2/3. And of course, Netflix, I think, is familiar to a lot of people, down from $690 to $285, another 2/3 loser in this group. The top-heavy nature of the market that was being driven by these names has now obviously changed significantly because of the performance give up by a very narrow group of companies. And it's actually made some differences in my S&P 500 fair valuation model, which for a number of years had actually been reading as being expensive, and at a few points last year, extraordinarily, like 2 standard deviations expensive. And I can report now that as of at least the end of September, after the market's significant sell-off through the end of the summer, that model actually went to what I would say a neutral reading, which is quite significant given that it had been at such high levels of valuation, again, driven by significant pockets of market cap growth and technology issues. So that's created a pretty big difference in my outlook for the S&P 500. And for the first time in a long time, I've been edging my investments in the equity markets away from other developed countries, such as Britain and Europe and a number of the majors in the Pacific Basin. And I've been actually reallocating them into our core global fund, which has got a very significant allocation to the USA, an area of the market now that I think is not nearly as risky as it was, and it might actually globally be providing some pretty interesting opportunities, at least on a relative basis. I'm thinking it's where you'd like to be. So one of the things that I do in the pension funds is I have an ETF that I use, which is follows developed countries, non-North American, and I've been actively allocating away from that ETF, and I've been putting those funds into the core global fund. And I'm looking forward to next year, as markets seem to be finding themselves, finding their bottoms, and you'll see higher lows as we crawl back to a normal equity environment, which I believe could be coming in the not too distant future. So that was a big change for me in the North American outlook, specifically moving from non-North American developed countries into the main major U.S. holdings in the core global. Also, importantly, in the pension funds is a very healthy weighting towards Canada, which has been a very good place to be, relatively speaking, over the last 12 to 18 months. The Canadian market has held up much better than some of the other developed countries that we follow, particularly the USA. And I made the effort probably about a year ago to start looking at defensive Canada. And I went into defensive or low beta Canada because obviously I was worried, as everybody else was, for higher rates and a derailed equity market, both of which we've now experienced. And I wanted to be positioned in companies that would have less of an overall sensitivity to the equity markets in general. So that meant that I moved the predominant share of my Canadian investments into Core Canada. The NCM Core Canada portfolio is specifically designed to be defensive and lower beta. That was then, and this is now. I'm looking at the outlook for Canada in a little bit more of a positive light. I'm believing that it might be time now that the core Canadian model has served its purpose as a volatility dampener, and I'm now switching that allocation from being 2/3 core Canada and 1/3 income and growth, another NCM fund, and I'm now switching that to 2/3 income and growth and maintaining a 1/3 position in the core Canadian portfolio. So as far as allocations within an individual market, this is a significant move. And it's one that I'm doing with the prospects of 2023 being a better year for equity markets in general and a better year for income and growth as a portfolio and a mandate and a theme of its own. So that now gets me to my ideas about fixed income, also another area where we had gone to a very defensive positioning over the last couple of years with the anticipation that the rate cycle would see higher interest rates. And in fact, we've now seen them. If you look at inflation as the driver for central bank policy, I would say that we are taking the opinion here that we have seen peak inflation. The activities of central banks all over the globe is and will be having the impact that they would like it to have. That means that it will be moderating to inflation in general. And that is something that you want to position for prior to the dust settling, if you will, on the current rate cycle. So that means that we are starting to edge out the yield curve a little bit. These are going to be modest moves. We'll be making them over the next few months as we watch the interest rate cycle play out and see what the activities are going to be with the central banks, both here, Europe, USA, pretty much everywhere in the globe where people have been tightening with the idea of lowering the interest or inflation back towards the lower single digits. We also have noticed that the current rate cycle has also created a bit of a dislocation in bond markets in general. And that dislocation is particularly hitting spread-driven bonds. That means your corporate bonds that trade at interest rate spreads above your risk-free governments. And we're seeing spreads have widened. And that has caused the situation where bonds that are corporate bonds, both investment grade and high yield, in many cases are trading at significant discounts to their par value. A discounted bond gives you the opportunity for a capital gain treatment on a bond price. So it's causing us to look at the corporate bond world both investment grade and high yield with increased interest. And so one of the ways that we're implementing that in our policies and our mandates is to reduce the short-term governments where we had been when we were worried mostly about interest rates rising, and looking more to both investment grade and in some cases high yield corporate bonds to pick up that double benefit of having higher yields as well as having capital appreciation embedded in the actual investment itself. And then lastly, I'd like to talk about the thematic investments in the pension fund. I hold a number of themes in the investment fund. They tend to be along the lines of secular themes such as global agriculture, global water, global infrastructure. And they also are themes which I call my new economy themes, which tend to be in ETFs that are predominantly owning high growth companies in the new economies, such as cybersecurity and electronic vehicles, new clean energy. I haven't made any changes in that portion of the portfolio. It's been a bit of a barbell for me for the performance. The secular themes such as global agriculture, global real estate, global infrastructure have done fairly well in this very rough markets over the last year. But the companies in the new economy have also been sensitive to what's happening to a lot of the growth companies in general. So as a package, they're down about 9%, which of course compares to a 15% down S&P 500. So relatively speaking, they're holding in okay. But I'm looking forward to a better year, particularly for the growth side of that, those thematic investments. So that concludes my comments on the positioning and the changes that investors will see in the pension funds. It's been a very busy summer, but I often like to tell people that I prefer to prepare for new changes in the market ahead of them actually happening. And that way you can reap the benefits from being early, hopefully, and making good decisions. So thank you very much, and we'll talk to you next month.